Hello, everyone, and thank you for joining us today for today's event featuring a fireside chat between John Brolin and Roy Barron. My name is Jim Kelly, the director of the Gabelli Center for Global Security Analysis at Fordham University. On behalf of the Gabelli School, a warm welcome. In the last several years, the Gabelli Center and our wonderful co-presenters, the Museum of American Finance and the CFA Society of New York, have sponsored more than 50 events that have drawn over 8,000 attendees. We are tremendously proud of this dynamic collaboration, and a full archive of our video content will be shared in the thank you email that you will receive. Now I'd like to introduce our speakers. Jonathan Brolin is the founder and managing partner of Edenbrook Capital, which he founded in 2011. Edenbrook takes a private equity approach to public markets, principally through concentrated long-term investments in small and mid-cap companies. John has 25 years of experience in public and private equity investing and investment banking. In addition, he's a colleague of mine, serving as a fellow at the Gabelli Center. He has also taught advanced topics in value investing for 7 years as an adjunct professor of finance at the Gabelli School of Business. John earned his MBA from Columbia Business School and his BA from the University of Pennsylvania. Roy Barron is co-president and co-chief investment officer at Westchester Capital Management, an investment management affiliate of Virtus Investment Partners, where he manages the Merger Fund, a $4.3 billion merger arbitrage fund. He joined Westchester in 1994 from the U.S. Securities and Exchange Commission's New York Regional Office, where he worked as an enforcement attorney for 7 years. Mr. Barron earned his BS in economics at the Wharton School, a JD at the University of Miami Law School, and an LLM in corporate law from New York University School of Law. John and Roy will speak for about 40 minutes, at which point they will address questions submitted through the question field located at the bottom of your video player. Please feel free to submit your questions at any time during the presentation. We will address them as many as possible at the end. Now, I'm delighted to turn it over to John and Roy. Thank you.
Jim, thank you very much for that warm intro. Roy, thank you for joining us. It's great to have you here today.
Thank you, John. Thank you, Jim. Good to be here.
Roy, you were a guest lecturer in my advanced topics class twice, which was a great thrill for the students, and I'm sure our wider audience today will really enjoy hearing your perspective on a really unique corner of the investment landscape. To start with, perhaps we can demystify merger arbitrage a little bit. You know, people tend to think of the bonfire of the vanities and all these people running around with suspenders and wheeling and dealing, but could you describe for our audience how you think of the practice of merger arbitrage?
Sure. Well, I took the suspenders off for this call, but I'll be glad to chat about it. Merger arbitrage involves investing in the shares of companies that are involved in publicly announced mergers, acquisitions, and other types of significant corporate reorganizations with the goal of profiting from the successful completion of those transactions. Typically, when a merger or an acquisition transaction is announced, the target company trades at a discount to the value of the consideration that you're going to receive when the deal is completed. So if a company is being acquired for $20 per share, for example, it won't trade all the way up to $20. It will trade at some type of a discount to that $20 value for the reasons of the time value of money, potential uncertainty as to timing, potential uncertainty as to regulatory approvals or shareholder vote, or maybe even financing. And all of those variables need to be handicapped by the investor to decide whether or not the investment is attractive at an appropriate discount to the consideration value.
Hey, can you talk a little bit more about your background in training? Jim mentioned that you went to Wharton undergrad and you have a law degree as well, and that you spent some time in the SEC. How has the combination of those factors prepared you well for this as a career?
It's been very helpful because it's not just a purely quantitative process. there are a lot of qualitative judgments that we need to make. We need to decide whether or not, for example, a transaction violates the antitrust laws and whether it will be challenged by the government. We need to evaluate whether or not the financing is appropriately in place. We need to evaluate whether they'll get the shareholder vote. When we put all those variables together, we then need to decide whether or not the target company is trading at a price that's attractive enough to compensate us for the risks that the transaction may not happen, as well as compensate us for the value of the money that we put up to make that investment. So the background, my legal background has been very helpful because every merger transaction is guided by a definitive merger agreement, which is a legal contract governing the rights and obligations of the parties. There are some conditions that need to occur. There are some other variables. There's a very key provision of merger agreements called the Material Adverse Change Clause that says that after a merger agreement is signed, if something very significant or material changes either at the level of the target company or the acquirer, then the other party may or may not have the right to terminate the transaction. And if a transaction is terminated, typically the target company stock, which often trades up because these transactions are announced at a premium to where the stock has been trading in order to entice the shareholders to vote for it. If the transaction is terminated, it will trade inevitably back down to some fair value level known as the unaffected price or the standalone price, which is typically somewhere near where it was trading before the transaction was announced. So we need to evaluate whether the upside that's available to us is attractive enough to compensate us for the potential downside if the transaction is terminated. And so the legal background that I have has been very, very helpful. The business background is helpful because we obviously have to figure out what a company is worth if there's no deal and where it would trade to. Because very often, sometimes during the pendency of a transaction, the stock market will go up, its peers will go up, the company may have announced earnings that will change the value of where the company should trade as well. So it's a very, very dynamic process. And there are a lot of things to consider in deciding whether or not to make this investment. As a good friend of mine has said, it's much more of an art than a science. There are people that have tried to invest in merger arbitrage just using quantitative tests or systematically or programmatically, but it's very, very difficult. And at the end of the day, it's the portfolio manager's judgment in deciding whether to invest in a transaction and how large a position to take.
That's very helpful. Thank you. We're going to go into some specific examples, but I think it would be helpful for our audience to try to understand how does a merger arb fund like yours fit into a larger investment program. So first off, when you first joined the merger fund at Westchester Capital Management, I believe at the time it was the only mutual fund that was focused on merger arb. And since then, participation has changed a lot. Some of the classic participants like the prop desks have just gone away. Others have come into play. Can you talk a little bit about where the merger fund sits today and why that structure is a good one for pursuing this strategy?
Okay, so I'll address your first question first, which is kind of in essence, what you're asking is, what is the value proposition for a merger arbitrage investment? As I mentioned, the investments that we make are predicated upon the anticipated success of a publicly announced merger transaction. And for that reason, it tends to be a market neutral investment, meaning that it's uncorrelated with the market. The investment is successful if the transaction is completed and not successful if the transaction is not completed. If the market skyrockets during the pendency of a deal, and in my prior example, let's say it's trading at $19 and the deal price is $20, we're going to get $20 if the deal is completed. We will make that $1 known as the arbitrage spread, regardless of whether the stock market goes up or down or sideways. And if it's a cash deal, it's regardless of whether the acquiring company stock goes up or down or sideways. So the risk that we're incurring is not market risk or directional risk. It's the risk of transaction completion or transaction failure. And for that reason, our returns tend not to be correlated with the stock market as a whole. Our beta historically over the past 30 years has been sub 0.1. The standard deviation, which many people use as a measurement of risk or volatility, is typically 1/5 to 1/6 of that of the overall stock market. So sort of the attractiveness of this strategy is more as a diversification to one's portfolio, as maybe as I wouldn't call it a hedge, but as somewhat of portfolio protection against a significant market drawdown. The market's down, 19% this year. Our portfolio is up a little bit this year. And it's very important because even in the case of bonds are down a lot this year. If you have a bond portfolio, you're down, I don't even know what bonds are down. Treasuries are down 12, 13, 15%. So if you look at a year like the great financial crisis of 2008, you'll see that the 60-40 portfolio that many people use as representative of a diversified portfolio was down in that during the financial crisis, something like 19%. Mm-hmm. And that's happening again this year. Bonds are down at the same time that stocks are down. Some people think that bonds are a hedge to stocks sometimes, but not always. This year, if you had a 60-40 portfolio, you would be down 18.5%, similar to the great financial crisis. And so there is a use for strategies such as ours and other market neutral or uncorrelated strategies that provide protection in the event of a significant market drawdown, and that that people are looking for as a to use a phrase, the sleep well at night fund. We're not going to knock the cover off the ball if the market's up 20%, but on the other hand, the drawdown should be significantly less than the stock market or the bond market. And we tend to have a positive correlation with interest rates. So if interest rates move up, even though bonds may go down, as those of you in business school know, if interest rates move up, an existing bond is worth less. The expected returns available in merger arbitrage would increase in a higher interest rate environment rather than decrease.
So even though, and it's timely because we're speaking the day after the Fed has raised rates yet again and is likely to do so several times again, to some extent, the interest rates have an impact on overall M&A activity because of the cost of financing. But from where you sit, you'd be perfectly comfortable with rates continuing to go up a little bit because it should have a positive correlation with your returns?
I think that's correct. I mean, the cost of financing is a factor in what acquirers will pay for target companies, because when you net present value, your cost of your investment, if your interest rate on a loan costs you more, then there's less that you can pay. However, companies take that into account, and there are often strategic reasons for transactions other than just financially driven reasons, such as capital is cheap or their stock has gone up and they have expensive, valuable currency.
How do you think about structuring an investment in merger arb? How many of them do you generally have at once? Obviously, it's a function of the deal environment, but how do you think about sizing them? How do you think about the risk reward of one opportunity relative to the other? How do you construct a portfolio?
That's a very good question. And I will tell you that if you put 20 merger arbitrageurs around a table, they'll have 20 different ways of structuring their portfolio, 20 different weightings in the deals that they like. So they may be in some deals that may not be in other deals. Just as an aside, merger arbitrage is what it's called now. In the old days, it used to be called risk arbitrage, because we're taking on the closing risk of the transactions. So the famous guys that were thought of as cowboys, the Ivan Boskis, the Carl Icahns, used to be risk arbitrageurs. Now everybody's merger arbitrageurs, and it's the visibility of the strategy is more of a safe, steady return strategy than a cowboy shoot out the lights type of high return hedge fund strategy. But setting that aside, for that reason, the studies that we have done indicate that you can get appropriate diversification for a merger arbitrage portfolio from about 20 different transactions. But there is an asymmetric return profile when you make these investments. Typically, when a transaction is announced, the stock will trade up and close to, but not all the way to the deal price, which means that you stand to make a little bit compared to the amount you stand to lose if the deal is terminated. So therefore, in our view, the way we've optimized our portfolio is to limit the size of individual investments, to minimize the single event exposure, and to diversify the portfolio as much as possible. Currently we have about 70 or 75 different mergers in the portfolio. And in our view, the more the merrier. It diversifies the portfolio further, it smooths out some of the volatility, and it minimizes the amount that you can lose in the event of a single concentrated investment not working out. There tends to be a little bit of a correlation to the stock market on a very, very short-term basis, being that when there's a market panic or people take risk off, they sell things indiscriminately, and merger arbitrage spreads tend to widen out. Additionally, in a significant down market, in a drawdown, the downside of your target companies would be lower than it would be in a bull market. So you may have more to lose, and the arbitrage spread will compensate for that. So those are all things that we take into account. If an arbitrage spread widens out, we may find that it's more attractive because the odds of the deal being successfully completed haven't changed. And so we stand to have a wider spread relative to the amount that we can lose.
And do you think of it differently also in terms of cash deals versus stock deals? Is there either a weighting that you'll use in the portfolio where we only want to have a certain amount that are either cash or stock, or is it all just deal specific?
No, that's a very, very good question. The strategy itself is market neutral as long as you hedge out the directional exposure. Now, we invest internationally. So another example of what I gave you the $20 cash deal scenario where we would just buy the stock for whatever price, let's say $19, and we're going to get $20 cash at the end of the day. In the case of a stock for stock deal, if the acquiring company's stock is trading at, let's say, for example, $10 per share, and they're offering $2 per share for every one share of the target, then we would need to sell short 2 shares of the acquiring company's stock to lock in that $20 deal value. If we didn't do that, and the acquirer stock traded down even $1 to $9 each, we'd only get $18 of value. If it traded up, we'd get $21 of value. It may work out, it may not, unless we hedge out the directional exposure to the acquiring company's stock. So for that reason, we view both of those transactions as equally market neutral and equally attractive. Additionally, when we invest internationally, if we're going to get paid in pounds or euros or something like that, we'll hedge out the currency exposure as well. We'll make a forward sale of the currency that we expect to receive when the transaction is completed.
Is it hard?
In terms of sizing the positions, there are ways to conclude or forecast what, in our view, are the most attractive transactions. The transactions where you're getting paid the most for the least amount of risk that you're taking. And you can look at it a number of different ways. You can look at the expected value, meaning the likelihood of the transaction being completed times the consideration plus the likelihood of it being terminated times where it would trade down to. Or you can also look at it from the variability of the different outcomes. How much do you stand to make versus how much do you stand to lose? What is the standard deviation of that? The same way that you may look at a Sharpe ratio in analyzing a particular investment. So there's a quantitative way to look at your risk reward profile, but at the end of the day, it's all based upon qualitative judgments that we need to make about the likelihood, most importantly, of antitrust approval, among all those things.
Is it harder for you to get comfortable with international deals, either because the rules of law might be different in different countries, or the documents are different than what you might see here?
It depends on the locale. The EU is very predictable. Japan is very predictable. Australia is very predictable. We're not going to make an investment in a North Korean rocket company, or Brazilian, something that's by a government that controls the industry. And so that's why we kind of handicap the odds of each of the individual risk items and try to forecast what the overall likelihood of success of the transaction would be. And when you have a company or a transaction that requires, let's say, Chinese approval, for example, very often, China is so interwoven into the world economy these days that many transactions, even between 2 U.S. companies or between a U.S. and a non-Chinese company, may require Chinese approval. So we have to handicap the approval by the Chinese regulatory authority, known as SAMR, State Administration of Market Regulation. And for that, we try to obtain the advice of counsel, whereas in the States, we use antitrust counsel, all around the state. In the United States, in Europe, we use EU-based counsel. And in China, it's a little bit more difficult because it's an opaque process. So we have to kind of grade down, in terms of our assessment of the predictability of a transaction that needs Chinese approval.
So would that have been something like Qualcomm, NXPI, where even though neither of those was a Chinese company, it was a Chinese regulatory body that blocked the deal?
That's a perfect example. They needed Chinese regulatory approval. And just for the record, China has a a very good track record of not blocking deals, but if they want to block a deal, they'll sit on it and not provide the approval. And that's what happened in the NXPI deal. They delayed, they didn't approve it. They kind of sent an unofficial message that it wasn't in the cards, and the parties had to terminate the transaction. But there have been a number of other deals, even in sensitive areas such as high tech and chips, both fabricating as well as chip sales, that have gotten Chinese approval. China is a huge market, and they're very embedded in the world market for all kinds of technologies as well as other types of industries. So they want to continue to be a player, and although it's not as predictable and is affected by some political considerations, they approve more than they block.
You mentioned that you try to handicap the regulatory environment. Switching gears to the United States, the Biden administration has been somewhat more activist on the regulatory front. The Justice Department has been attempting to block numerous deals. How do you think about the current environment? Does it make it harder to predict how deals will close, whether they'll close, or do you simply have a higher threshold for them, or is it the companies themselves that have to decide whether or not, once they get to the table, they've already gone through their own regulatory process of trying to determine whether or not something's likely to get clearance?
So I think you answered part of the question yourself at the end. The parties do a lot of work when they announce a transaction. They hire lawyers, they hire accountants, they hire bankers, and they do a thorough review of the antitrust dynamics prior to announcing the deal. I mean, no company's going to want to waste hundreds of millions of dollars on professional fees if they think the deal is going to be blocked, or at least attempted to be blocked. Just because the Biden administration takes a very strict view and interpretation of the antitrust laws doesn't necessarily mean that they're right all the time. If you look at the AT&T Time Warner transaction, the DOJ tried to block that. The companies fought it in court and they won. Just yesterday, there was another transaction. Change Healthcare was being acquired by United Healthcare, and United Healthcare fought the government. The government sued to block the transaction, and they lost. And we just got a positive opinion from the judge on that. So they still need to comply with the federal antitrust laws. And the parties have professional advisors that are well experienced. Many of them are ex-government prosecutors themselves that are able to opine on whether or not a transaction is violative or not.
And so are there specific metrics that you'll look at, whether they're market concentration, et cetera, in order to, in order to make a determination as to how much risk you think is implicit in a given deal from a regulatory perspective?
There is a measurement that the government uses called the Herfindahl Index. HHI is what people use as an acronym for it, and it does attempt to make a quantitative measurement of the concentration level that would occur once a deal happens. But there are other factors as well. Sometimes it doesn't take into account future competitors. Sometimes it doesn't take into account failing companies. But it's just a tool or a guidance. We use multiple outside antitrust counsel to help advise us on what we think the odds are of the approval. Typically, the approval process is that the companies need to make something called a Hart-Scott-Rodino filing with the government for approval from the government. And then the government decides, number one, if they're going to make a request for additional information, to think about it further and decide whether they want to advise the companies that they think it's a violation, or they may approve it right away without making what's called the second request. So the council will help us forecast whether or not there will be a second request, how long it will take. Sometimes the companies will work with the government and decide to extend the period so the government doesn't have to issue a second request, or known as a request for additional information. Sometimes they, at the expiration of the Hart-Scott period, which is the period that the government needs to make up their mind, they can't just drag their feet on this forever. The government may ask the parties for an extension of that period as well. So it's a very dynamic process, and it's very helpful to have professional advisors. We don't practice antitrust law, but it's a changing field. So for us, it's extremely helpful to have lawyers on retainer that can help us sort of forecast and kind of odds make the odds of that particular that particular approval that's required or conditioned to the transaction.
Can you talk about a transaction in which you were particularly positively surprised by the outcome? as well as one where you were particularly negatively surprised?
I don't know, to be honest. I don't know if there were that many that we were positively surprised because we're in it because we think it's going to get approved, but
Right.
negatively surprised, we were very surprised about the NXPI deal. That blew us away because there really was no antitrust overlap. And we think it got kind of caught up in the politics of the time. There was US-China trade issues. Qualcomm wasn't necessarily an effective partner for China. In terms of other negative surprises, I mean, we're surprised. We didn't think that chains would be challenged. We thought that there were no antitrust problems there, and it was the government tried to block that as well. Just recently, there was a deal in Australia called Link Administration. It was a financial company that got their approvals except for UK, and the UK authorities decided that they wanted the acquirer to be on the hook in case the target company was liable for a gigantic potential legal judgment in a case they were involved with, and that came out of the blue, and that surprised us. So sometimes we do get blindsided by these things. Back in the old days. This is an interesting anecdote. The clause in the contract that I was talking about earlier, called the Material Adverse Change Clause or the Material Adverse Effect Clause, has evolved over time. After the September 11th, or after the market crash, there were modifications to your standard Material Adverse Change Clause, because when parties sign a merger agreement, they expect the deal to be closed absent something wildly material that happened. So we saw after the market crash that merger agreements that were signed included carve-outs from the Material Adverse Change Clause that said that market downdrafts are not grounds for terminating the merger. After September 11th, we saw clauses in these merger agreements that said acts of terrorism are not grounds for terminating the merger. After Hurricane Katrina, we saw provisions in merger agreements because that hurricane caused a deal to be terminated when an oil refinery was washed away or something like that. So then we saw provisions in the merger agreement that said that natural disasters and acts of God are not grounds for terminating the merger agreement. And of course, I'm sure everybody will be able to guess what the latest carve out from Material Adverse Change clauses are, which is pandemics and COVID. They are now in the latest iteration of merger agreements, standard merger agreements, carved out as grounds for material adverse change, unless it disproportionately affects that particular company compared to the other companies in its sector. Mm-hmm. So it's very, we need to keep up to date and up to speed on the laws, on the regulatory approvals, the financing environment. Lots of companies. There's a ton of private equity money out there right now. There's in the neighborhood. The number I've seen is $2 to $3 trillion of private equity money, known as dry powder, for them to use to announce acquisitions and make deals. And they don't just buy with cash; they lever up their transactions. So if you do the math on that, we're talking about many potential trillions of dollars of transactions, much of which needs financing. Now we're in a higher interest rate environment, so the next thing we have to consider is how available is the financing? Are banks going to still be able to commit to loan the money? Because these transactions will only happen if the banks make a commitment. So will they still make the commitments? How will the cost of the new financing affect the transactions that they're thinking about or that they've already announced? I don't know why I got off track on this, but
will you still participate in transactions that are private equity led?
We certainly will. We want to, we're going to read the merger agreement to help us understand the commitment of the parties to the transaction. Many private equity transactions are roll-up transactions and not just one-off transactions where a company is going to make an acquisition, sell off the parts to pay for itself, dividend money back to itself. Many of these private equity transactions are roll-ups of prior transactions that they've done also. So we're going to read the merger agreement. We're going to make sure that the financing is in place, which inevitably it will be. The only time I've ever seen banks not honor their commitments have been when there was either a material adverse change at one of the companies, or during the great financial crisis when banks just fell down on their commitments. And during that period of time, it was a real crisis, and we bought some credit default insurance as a hedge against that. But that's an example of sometimes we have to put on a macro hedge in our portfolio to account for significant events such as financial crisis, market meltdowns, or things that come out of the blue. Like, you can't hedge away fraud at a company. If it comes out that a company has defrauded its shareholders or is liable for a gigantic criminal fine, we can't hedge that away. The best we can do is invest based upon our own assessment of the likelihood of the transaction being successfully completed.
And in general, the hedging that you might do if you have a strategic acquirer and they're paying stock, you obviously can't do that if private equity investor is paying cash. But from your perspective, is that just similar to a strategic offering a cash deal? Do you think about them similarly?
Yes, we do.
Okay.
We do. I mean, again, it comes down to our ultimate assessment is in our mind, and what we have our portfolio meetings is what is the likelihood of success of the transaction, and that decision is going to have a number of components to it, and the strategic rationale is an important component because it will indicate to us the commitment that a party may have to a transaction. Strategic buyers often have a much longer term perspective. There may be a strategic imperative such as increasing a product line, obtaining some efficiencies, saving cost savings from combining these. If it's a one-off private equity deal, you really don't have those efficiencies. And if something, if there's a downturn, you may see the private equity buyer look for some kind of loophole in the transaction to either get out of it or reduce the price. You tend not to see that as much with a strategic buyer.
And you mentioned the changes that can occur in different financing environments. We've seen a number of situations in which banks have been stuck with holding debt on deals that they may have had trouble syndicating. Is that something that you're seeing more and more? And how do you expect that to play out given where we are in both the economic environment and the interest rate environment?
Another good question. We are starting to see that right now. We haven't seen that for a while, for a number of years. The latest test of this is going to be the debt that is floated for the Citrix transaction. That's an LBO. Much of it has been placed already. The banks are on the hook. This deal, as far as we can tell, is going to close anyway, even if the banks don't fully syndicate it. They may own some of the debt themselves because they've committed to providing the financing, and then they'll try to offload it. They've been lowering the price so far in order to minimize their exposure. In fact, I think I saw that one of the parties agreed to buy a lot of the debt. One of the transaction parties agreed to buy a lot of the debt itself. But yes, that is something to watch out for, and that's one of the reasons why we want to make sure that the financing, where there's a cash component, is fully committed or is in place on the balance sheet of the buyer.
And one other area I wanted to bring up regarding deals potentially falling apart are people walking away. I mean, and there's some little birdie suggests there'll probably be some questions about that in the Q&A. So I'll leave the most high profile one for that. But I think the Fresenius Acorn deal was one that you knew well. When a buyer just decides to walk away, how do you handicap that? And are there signs you can look for? I mean, if the chatter starts to happen that a buyer isn't interested, is that a tell that X% of the time it's not going to happen once they start talking that way?
Well, it's the whole point of a merger agreement. These are, DMAs, definitive merger agreements, have provisions which specifically define the circumstances under which a buyer can terminate the transaction. In the Fresenius case, Acorn, turned out to be basically a house of cards. Fresenius didn't just decide, I don't want to buy them anymore. Buyer's remorse is not a reason to terminate a transaction. Once you sign a contract, you have to fulfill the requirements of that contract. There are representations and warranties, conditions to the obligations of the parties, and if those conditions are met, it's a binding, enforceable, legal agreement. We're going to run into that as long as you brought the subject up. There's a lawsuit going on right now with Twitter. Elon Musk, can't unilaterally decide that he doesn't want to buy the company anymore. He has to actually find a reason, such as a material adverse change or a breach of one of the covenants by Twitter, in order to legally terminate the transaction. And that's the case with all of them. Just because a company starts grumbling or a buyer starts grumbling doesn't necessarily mean they can terminate, but it does mean they might be on the lookout for grounds to terminate. So if there is a material adverse change, sometimes the buyer may still want to buy it, but there was a recent case. I think Thoma Bravo was buying Anaplan, and while the transaction was pending, the companies were, everybody was going down the road. They were starting integration, and it turned out that Anaplan had paid their executives an extra, in the total context of the transaction of a multi-billion-dollar transaction. I think they paid them an extra $35 million, or maybe it was $100 million, something like that. But it was a technical breach of the transaction. And the buyer said to Anaplan, "You've breached the transaction. We don't want to pay the same price anymore." It was obvious because the market has come down. Tech stocks have gotten hit. Healthcare, processing stocks have gotten hit. So the buyer said, "You know what? We're going to terminate pursuant to our rights unless you agree to a cut in price. We still want to buy you, but you did something that breached the agreement." So they agreed to a cut in price, and the transaction closed. People are thinking that in the case of Twitter, that might be the path here. But as far as we can tell, we think the company Twitter has, I'd be glad to expound on this, if there are any other further questions. But,
Sure.
At this point, it's a very contentious litigation. The parties are using all kinds of motion practice and mudslinging to fight this. But our early assessment is that Twitter has a much better case than Musk in holding them to the transaction instead of allowing them to terminate.
So when you look at something like that, are there situations in which you will just say either too hard or too complicated, or someone's too mercurial? I don't know if I want to get on the other side of this, or is that all something that can be solved for with math?
No, 100%. You're right. It's, like I said, it's everything is a qualitative judgment. And early on, we read the merger agreement. It's an excellent merger agreement, and I'm talking about Twitter. It's very, very tight merger agreement. It allows the buyer the target company, the seller, to seek what's called specific performance, meaning allowed to sue him in court rather than get damages to require him to complete the transaction. The guy waived due diligence on the main reason that he is now claiming was a violation by the company, the level of bots and fake accounts. They said to him before the transaction, "Would you like to do due diligence to investigate it?" And he said no. And he signed the transaction anyway. There's no provision for the maximum number of bots or fake accounts. There is, of course, a requirement that anything the company says be true, and anything they put in an SEC filing needs to be true. So that's something that's going to be argued about and is being argued about right now. But, if you look at it, they said, we think there's 5% bots, and to tell you the truth, we could be wrong. We're calculating it. It's a very, it's a judgment call. We could be wrong, could be higher, could be lower. This is what they put in an SEC filing. So, now there's a whistleblower, which coincidentally comes out just and claiming the same things that Musk is trying to claim. And then Musk now took his deposition, is using him as a witness. It's just not, it's a question of the court assessing the credibility of the parties here and deciding whether or not there's been a material adverse change or a violation of the promises and the covenants and all of the provisions of the merger agreement.
So how will you combine that qualitative analysis with the quantitative analysis to say, therefore, given everything we think, the way we read the merger agreement, et cetera, we will therefore either size it this way or we will hedge it this way? Or how will you take that qualitative piece and have it inform your quantitative decision?
So from a quantitative perspective, we look at probably the most significant factor is how much value are we putting at risk in a particular position size. So if a company, for example, biotech deals are often struck at very, very large premiums, 80, 90, 100% premiums. And so that means the downside is going to be more significant if a deal is broken. So setting aside the odds of completion, we want to know how much we stand to lose for every position size. If you look at a bank deals are struck at very small premiums, typically 10, 15% or whatever. Mm-hmm. So it's a lot easier to put on a 5% position where you're only going to lose 7.5% of 5%, or versus putting on a biotech position where you lose, where if you invest 2% of the portfolio and you lose 50%, you have 100 basis points at risk. So that's the first metric, is understanding how much we stand to lose versus what we gain. The second metric is comparing how much we stand to make versus the risk we're taking, which is how much we stand to lose. And that, we have a proprietary methodology for kind of calculating that, similar to the we use like a Sharpe ratio type analysis of that type of thing. But the point being is that the quantitative aspects are calculating what we think the odds are of success, incorporating into that analysis the upside, the downside, the odds of those various outcomes. And sometimes we have to include the odds that a company may raise its bid because there's an unhappy shareholder, or there may be, we look at the proxy and there may have been three parties that were bidding, and so there may have been an overbidder. Occasionally you have a bidding war. And so we try to incorporate those dynamics into our assessment as best we can, as the deal is moving along. One important thing to note is that if, let's say, a company has a bad announcement and fundamentally it's not as strong, we may reduce the size of the position, because unless the spread widens out, we would stand to lose more versus making the same amount of money, and vice versa. If a sector trades up 25, 30%, we assume that the downside is not going to be the same as it was before, and it may make it more attractive. Even though we stand to make the same amount of money, we may lose less. So the risk-reward ratio may be better for us, and may cause us to either increase a position or put one on if we haven't put it on yet either.
So you mentioned the Anaplan repricing, and the day that happened, a number of other software transactions that were mid-process traded down, some quite sharply. Will you be opportunistic in situations like that and say, hey, we know this to be an Anaplan specific situation. These other ones are trading off just because of that, and add to allocations in other ones that might be being impacted by something that's viewed as more systemic, but is really very specific?
100%. If one company trades down for idiosyncratic reasons that are not related to the other companies, either in the sector or that are LBOs also, and our assessment and our forecast has not changed for the other companies, it will probably create a buying opportunity for us, and we would have no problem adding to the position. We look at these things. Every deal rises and falls on its own merits. Every deal has its own merger agreement that is enforceable. And so in the Anaplan, we looked at it and said, this is a one-off. This is unlikely to happen. And the other deals in the space have proceeded to closing.
Yep, we had one like that, Tufin Software, which was bought by Turn River, traded off sharply when that happened, and it was a non-event. I know we have a lot coming up in the Q&A, because we do have a lot of students who are on and following, as well as some recent graduates. I do want to ask, from a career perspective, what sort of advice would you give to someone who is coming out of school and is interested in merger arb?
I would say read up, so that if you are fortunate enough to get an interview, you're able to be prepared and talk intelligently about the space, about deals, about understanding why it is that you can make money in merger arbitrage. If you can get a summer job doing anything even tangentially related that shows that you're interested, that's something that would be helpful also. And understand the math of a merger arbitrage investment. Kind of understand why or why not it would make sense to make the investment. But most important thing I would say is that we've interviewed people. You have to be prepared for the interview and be prepared to talk about why you want to do merger arbitrage, why you want to go to the particular company that you're interviewing for. People want to hear that you've done the work, because they're going to hire you to be for the long run. This is a strategic deal as opposed to a financially driven deal like private equity. You're coming to work for a company. They expect you to stay. You're going to want to stay. This is a career. So show that you want to be in the space, that you're interested in it, and read up. I mean, there are a number of books out there. Mario Gabelli has a good book out called Merger Masters that kind of gives bios of a number of different ones. I have to admit, we're in it also. My partner Mike and I are in it as well. But it's a very good deal. Has lots of interesting anecdotes in it. And there's some other books. If anybody needs a recommendation, I'm happy to provide it.
And a nice unprompted plug for the Gabelli School there as well.
Exactly.
Jim, would you like to open up the Q&A? I know we have a bunch that have come in.
Okay, wonderful. Well, I'll be joined in the questioning by my colleague, Professor Srish Chatterjee, and we encourage additional questions to come in. We have a bunch already, but we're open to take more. I'd like to just start it off. There's two questions about the Microsoft Activision merger. Roy, could you comment on that?
Yeah, I think that that's a very good one because it's number one, it's very interesting. A lot of people know about the Activision products. This Call of Duty is, I think, the most successful video game ever. And also, in light of what we were discussing a little bit earlier, the Biden administration has taken a tougher line on antitrust, particularly with regard to big tech. And they don't like Google making acquisitions. Amazon has 2 pending acquisitions right now, and Microsoft either. The issue here is whether or not this very, very popular game made by Activision, the Call of Duty, would be would be ring fenced once Microsoft completes the acquisition and not allowed to be distributed or played on competing platforms such as Sony PlayStation and other small ones. It's a very big selling point because people who have Sony PlayStations want to play Call of Duty. They want to play with their friends. And if you can't play it on the PlayStation platform, they might not buy a PlayStation. They might buy an Xbox instead. So people may say, well, once they buy it, it's a Microsoft product. Why can't they do what they want? We think the transaction will be allowed because you'd be stupid to buy a company with a product line and a revenue stream like Call of Duty and then cut it off because it's $1 billion plus franchise. So they wouldn't buy it and then lose money on it just to kind of warehouse people in it and at the end of the day, not make it an economic transaction. That's number one. Number two, Microsoft has agreed to leave it open to PlayStation, allow it to be available on PlayStation and other type of PC type platforms, if that would satisfy the regulators. Their goal they want everybody to play video games. They want it to be successful, and I think they're saying the right things. At the end of the day, I think it would be tough to challenge based upon that. But the government might give it a shot. The other thing I would point out is that, as everybody may or may not be aware, Warren Buffett of Berkshire Hathaway has acquired a very large position. I think he bought almost 10% of the company. I don't know what he's thinking. He hasn't commented publicly on the reason for it or whether he thinks the transaction will happen. But it is a statement at the very least about the fundamental value. He's a Benjamin Graham type of acolyte, and it does make a statement about the fundamental value of this type of a business. So, and the other thing I would add is that we think it's underpriced in the market compared to the likelihood that the transaction will actually successfully be completed. That's an important factor that we look at, which is it mispriced in the market? Is it inefficiently priced, I think it's reflecting like a, less than 50, I don't have the numbers in front of me, but it's reflecting a much lower likelihood of success than we think is probable.
Well, first, thank you, John, and thank you, Roy. John, if you recall, I used to sit in your class and I learned a lot from your lectures, but I had missed Roy somehow when he came as a guest speaker. So I think I more than made up for that previous class. Let me start with a question from the audience. This one is from Arif Jan. The question is, does this investing strategy deliver any benefits to the acquiree or the acquirer or any other party other than the merger arbitrage investor? And let me add my own comment to this question. There is some research that shows that almost 50% of the drop in the target in the acquiring company's share price can be explained by merger arbitrage. Your comments?
So, I'm not fully clear. I mean, I think the acquirer wouldn't make the acquisition unless they thought it was beneficial. There are often, if it's a let's talk about a strategic buyer, not a private equity buyer. There are often cost saving synergies. There's consolidation of overhead of factories. There's top line synergies in terms of potentially marketing additional products. There's production synergies possible. There are many benefits that can occur and that can accrue to the buyer. In terms of a private equity firm or a private equity buyer, they may perceive the company as being inefficiently managed, and they think that it can be run better either when combined with one of its portfolio companies or just with better management or better expense policies or financial policies. There's a million reasons why companies may make acquisitions, And otherwise, if there were no benefits, they wouldn't announce it. So I don't, I'm glad if it benefits us also, that's great. But we're not the ones that made the decision to announce the transaction. Sometimes they don't work out. And by the way, Sri, to your point, sometimes there is a downward pressure on the acquiring company's stock as a result of arbitrage hedging in the case of a stock for stock deal. But very often, if it's a cash deal, the acquiring company stock may trade down for a variety of reasons, such as if the public thinks that they overpaid for the transaction, if they think the synergies are overstated, or for a variety of other reasons. So I wouldn't necessarily correlate the stock price movement with arbitrageurs, alone.
Thank you. Jim?
Here's a question from Harris Arch. What is your view of shorting deal spreads in certain very tight ARB deals, i.e. overbids that don't happen, spreads below risk-free, etc.?
Good question. It is a useful strategy occasionally. We rarely do it. The risk-reward profile is kind of flipped on its head, because when a merger arbitrage deal is announced, you stand to make a little and you risk losing a lot. So if you reverse the deal and you short it, then you potentially stand to lose a lot but make a little, keeping in mind that the odds are very low that you will make that huge windfall. Most of the time, I think the statistics are that publicly announced mergers and acquisitions tend to be completed in the neighborhood of like 90 to 92%, or some very, very high number like that. If you find a deal that you think is anomalous and is trading at a value that far exceeds the likelihood of the deal being successfully completed, such as when there's overbid speculation or something like that, then you can make some money doing that. Particularly in the case of a private equity deal, sometimes target company stocks will trade at above the deal price due to speculation that either the company hasn't been properly shopped, or when you read the proxy, you'll find out that there were 3 companies that bid, 1 company bid more, but the target company didn't like the fit or something like that. So, occasionally it'll trade through the deal price and maybe a somewhat attractive short. But in general, you really have to pick your spots on these, because you're going to lose most of the time if you reverse the transaction.
Here's a question from Jeffrey Eichen. How do you outperform the market with your antitrust assessment when market prices are driven by antitrust counsel opinions of likelihood of closing? I guess the underlying question is, how much does the market know, or how much?
So, that's the old efficient market question. Whether you think the market is efficient or not efficient, or strongly efficient or partially efficient. I would argue that, as I mentioned, arbitrage is more of an art than a science, and I think that you can find multiple instances where the market does not efficiently price a transaction. I mean, if you look at Change Healthcare, the market was pricing in a distinct possibility that the government would win, but the government did not win, and the stock traded up. If you look at Time Warner, AT&T, the same thing. There are times during antitrust analysis where the market might be more pessimistic. You could argue that, look at the Activision Microsoft case. You could argue that it's much better than a coin flip. Market is pricing it in that it's barely a coin flip. But again, I think it's, pricing in very, very low odds of successful completion, but we think it's much, much higher than that. So, as they say, that's what makes a horse race.
Okay. Roy, here's a question from Matthew Simoneau. Do you take into account the personalities and personas of leadership involved in the acquisitions to potentially avoid a situation like Twitter?
Yeah, that's a good point. We do, and that's the reason why we and most other arbitrageurs did not have a large Twitter position when the deal was signed, despite the fact that it's a very good merger agreement. Is because he's, the guy is mercurial. You can't predict what he's going to, look what he's been doing. Not only that, I'm sure his counsel has been telling him to be quiet, and he's still tweeting and making public comments about this. When his commentary on this transactions were actually made on Twitter himself. He tweeted himself about the Twitter deal. But that's an aside. But it's a good question, and that is definitely one of the factors. You take a guy like a good corporate leader, like guy Ed Breen from DuPont. He's fantastic. He closes deals. He gets it done. Bruce Flatt from up in Canada is fantastic also at Brookfield. There are plenty of executives that have a great track record of closing transactions, and it is certainly a factor.
Well, here's a question from Daniel Cataldo, which I think is related to the earlier question from Jeffrey Eichen about the market. Daniel's question is, I understand that the CME recently launched event-driven contracts. Would two merger arbitrage funds ever engage in an event-driven contract, betting on the success of the merger or acquisition?
That's a really interesting concept. I'm not familiar enough with the product to give you an answer, but I can tell you if the economics made sense, we certainly would. There's no reason, as long as, I mean, again, if you're talking about two merger arb funds, I don't know what the counterparty risk would be. If there was not counterparty risk and the economics made sense to us, for sure, 100% we would participate.
Okay.
I want to follow up with a question, Jim, if we have some time.
Yeah, please go ahead.
This goes back to Roy's earlier comment about Chinese firms and John's question about international. So I'm reminded of a situation many years ago when GE and wanted to make an acquisition, and then the two firms agreed to the acquisition, but it was stopped by the European Union. This was GE and Honeywell. So,
yeah.
and it was approved by all US regulators, approved by the shareholders, but the European Union and the European Commission made a very strong case, antitrust case. And I don't know what your thoughts would be on a situation like that. This was completely unpredictable.
Please don't remind me about that one, because we were in it and it didn't work out well for us. But we thought the U.S.
I had no idea.
Yeah, no, the U.S. authorities, we thought did a very very deep and credible analysis of the antitrust. But I believe, and I this goes way far back. I think it had something to do with Airbus and jet engines, if I recall. But I could be wrong. The point being is that each individual regulatory approval is an additional event that needs to be handicapped and assessed with regard to making an investment. So you could be right on 5 regulatory approvals and wrong on the 6th, and the deal doesn't happen. And I can't say to myself, if I'm right on 5 and wrong on 6, that I did a great job, because the deal didn't happen. The important point is to be right. It's binary. Either the deal works or the deal doesn't work. And it's our job to be in deals that are successfully completed and avoid the broken deals. The real risk in our business comes from terminated transactions. So I would argue, as a philosophical point, that it's more important to avoid the broken deals than it is to be in the deals that make you a lot of money.
Yeah.
Thank you.
Well, we're just about out of time. It flew by an hour, but on behalf of everyone, I'd like to thank John and Roy, both of you, so much for sharing your wisdom with us about this really interesting topic. So thanks again, and thanks for all of you for participating today.
Thank you very much for having me. It was fun.
Thank you.